name is Brittany Saltzman, and today I will be analyzing 10 companies for Dr. Cresson's Finance 451 class. The 10 companies that I will be analyzing today are over two industries, the pharmaceuticals industry and the hospitality industry. The 5 companies from the pharmaceutical industry are Bristol Myers, Merck & Company, Roche Holdings, Sanofi, GlaxoSmithKline, and the hospitality companies are Hyatt, Marriott, Choice Hotels, Belmont, and Red Lion Hotels. First, we're going to start off with the pharmaceutical industry. The first thing I did when beginning to analyze these companies was pull information from the Risk Management Association website. So I looked up the NACE's code for pharmaceuticals, and it was 325412. So from there, I pulled financial information from 2014, 15, and 16. Now, the years are not identical to the ones that we used for the analysis, but it gives us an idea for comparable industry averages. Not all of the ratios that we were using were available either. I will refer to the industry averages here often throughout the presentation. It is important to compare industry averages because there is no necessary good or bad ratio. For example, a quick ratio of 10 could be terrible for one industry, and a quick ratio of 2 could be terrific for another. Looking at the information in front of us, we can see that Bristol Myers is fairly liquid. Although it is a tad below industry average, it's not terrible. They are not highly levered either. They generate a little over half of their assets from creditors and a little less than half of their assets from shareholders. This is reasonably proportioned, seeing as borrowing from creditors is cheaper, less risky, and lowers the tax liability. Bristol Myers does not have much debt, and they are able to afford what debt they have. They can pay their interest obligations to their creditors on average 19.37 times compared to the industry average, which is around 7. They have a fair amount of current assets tied up in inventory, but it is normal in the pharmaceutical industry. Bristol Myers is not very efficient. They generate only half of the value of their assets in sales. Their shareholders keep a higher portion of sales than other pharmaceutical companies, however. They have a lower return on assets and equity than the industry, but it is not a poor return. Unfortunately, return on equity and return on assets have been decreasing over the last 5 years. In analyzing the decomposition of the return on equity, operating margin seems to be driving the numbers down. Over the years, Bristol Myers has gone from adding value to the business to losing out on valuable opportunities. However, the market favors Bristol Myers and expects them to grow in the future. We also expect them to generate more cash flows off of their assets in the future as well. Enterprise value and enterprise multiple are similar to market to book and PE ratios, but show a bigger picture. Today, Bristol Myers' stock price is $63.24, and they are worth $112.7 billion as of 2015. Merck & Company holds onto a lot of cash. Roughly half of their current assets are cash. Unlike their industry, they do not have very much tied up in inventory, which can be a good thing. They can take advantage of more opportunities when more cash is readily available. The last 5 years, they have been levered half by creditors and half by shareholders on average. Additionally, they have a better time handling their debt than most in the industry, but not as well as Bristol Myers. Merck's efficiency is even lower than Bristol Myers on average, and much lower than the industry average. However, their profit margin is above average, meaning shareholders get to keep a generous portion of sales in comparison. Return on assets and equity are almost half of what the industry generates, but their returns are still not poor. A low operating margin and asset turnover seem to be driving the numbers downward. Looking at the price-earnings ratio and the market-to-book ratio, we can see that the market favors Merck and expects them to grow in the future. They also expect them to generate more cash flows off of their assets in the future as well. Additionally, they have increasingly added value to their company, with the exception of 2013. Merck & Company is worth $160.6 billion as of 2015, and today their stock price is around $55.87. Roche is a Swiss company, and all information is presented in US dollars for consistency. Comparatively, Roche Holdings is not as liquid as the industry or Bristol Myers and Merck. They do not have as much inventory held up in current assets either. Most of their current assets encompass receivables and cash. They are more highly levered than the pharmaceutical companies on average that we have analyzed. So far, leverage has been consistent around 2 for most other companies, and Roche's is about double that. They are getting between 75 to 80% roughly of their money to buy assets from creditors and only a small portion from shareholders. Like the other companies in this analysis, they can afford their interest obligations several times more than the industry as a whole. This infers they can manage their debt well. Roche Holdings is more efficient than Bristol Myers and Merck were, but they are still less efficient than the industry. Their profit margin is more than double that of their competitors. Unlike Bristol Myers and Merck, their returns on equity and assets are above the industry. Roche Holdings is a very profitable company. Their leverage is magnifying their gains. Not only can you tell mathematically in the decomposition, but in the change from ROA to ROE. Price earnings and market-to-book ratios show that they are expected to keep growing over the years. They have not had a steady trend, but consistently add value to their company each year through taking advantage of opportunity costs. Roche Holdings is worth $254.9 billion US dollars, or 250.4 billion Swiss francs as of 2015. Their stock price today is around $31.91 US dollars, that is, or 31.35 Swiss francs. Sanofi is a French company, and all information is again presented in US dollars for consistency. Sanofi, like Roche, has a current ratio that is a bit below industry average. Roughly, Sanofi has about 40% of current assets in inventory, 40% in receivables, and 20% in cash. They are not as liquid as they maybe could be. Not only is their proportion of current assets to current liabilities lower than we would like, but they don't have that much cash available either. This company could potentially have short-term troubles with liquidity in the case that something out of the ordinary happens. They could also have problems with paying their obligations in the short run as well. Sanofi gets money from its shareholders more than creditors, therefore they are not highly levered. And getting more money from your shareholders is more expensive than creditors. Likewise, they are able to afford the little debt that they have, well, like the other pharmaceutical companies that we've analyzed to this point. Sanofi is the least efficient of all the pharmaceutical companies. Their assets and equity returns are the lowest. Fortunately, their profit margin is higher than average, and a low asset turnover has driven the returns down for them. As you can see, Sanofi is expected to keep growing from 2011 to 2013. After seeing negative trends in 2014, the growth decreased a little bit. From 13 to 14, Sanofi did not add any value to the firm. As of 2015, Sanofi was worth $108.63 billion US dollars, or 91.5 billion euros. Their stock price today is around 44.62 US dollars, or 37.59 euros. The last of the pharmaceutical companies that we will be analyzing today is GlaxoSmithKline. They are a British company, and all information, again, is presented in US dollars for consistency. GlaxoSmithKline has the lowest current ratio of all 5 of the pharmaceutical companies, meaning they are the least liquid. We would be least likely to choose this company for any short-term investing. GSK is highly levered in like Roche Holdings. All of the other pharmaceutical companies borrow their money 50-50. Additionally, they have an easier time paying their interest obligations than the rest of the industry, just like all the pharmaceutical companies have. Their asset efficiency is lower than the industry. However, their profit margin, returns on assets, and returns on equity are higher. Leverage is magnifying the gains in the ROE decomp for GlaxoSmithKline. Finally, from 2011 to 2012 and in 2014, investors expected GlaxoSmithKline to grow. However, in 2013 and 2015, they didn't. Overall, the 5 years, Sanofi has added value to the firm. Oddly enough, in 2015, the overall value dropped by almost $10 billion and decreased again in 2015. As of 2015, GlaxoSmithKline was worth $81.3 billion US dollars, or 60.3 billion pounds. Their stock price today is around $35.32, or 26.31 pounds. So I chose Roche Holdings as the best of the 5 pharmaceutical companies that we analyzed. They were below industry average when it came to short-term abilities. However, they were still fairly liquid and capable of paying their bills in the short run. They beat the industry average in long-term abilities to meet their obligations. Additionally, they beat both the industry and all 4 companies when evaluating efficiency, profitability, and how the market favored them. Now moving on to the hospitality industry. Again, I went to RMA, or Risk Management Association's website, and I pulled the industry averages for 14, 15, and 16. The NACE's code for the hospitality industry is 721110. The current ratio for Hyatt is twice the average for the hospitality industry. They are highly liquid. You wouldn't expect a hotel to have inventory, and we can see that in the translation from the current to the quick ratio. Their current assets are primarily made up of receivables and cash. Hyatt borrows more money from their shareholders than creditors. I personally think that it's a better idea to borrow more from creditors because it is cheaper and you get a bigger tax break. However, at the end of the day, it is a personal preference. Ultimately, they are not levered much, and they can afford their debt like most of the companies in the hospitality industry. Hyatt hotels are equally as efficient as the industry. However, their return on equity, return on assets, and profitability are below the average for the industry. Although their tax burden and interest burden are high, the operating margin is very low and is driving the return on equity downward. Although Hyatt has not added any value to the company over the 5 years, they are still expected to grow a lot. They are expected to turn $1 today into $52.55 in the future as of 2015. Additionally, their stock price is currently at $72.46. And as of 2015, they are worth $7.4 billion. Marriott is not very liquid. Compared to the industry, they only have half of the current assets as their current liabilities, while the industry has double the current assets as their current liabilities. They also have next to no cash. They may run into troubles paying bills in the short run. Oddly enough, they are able to pay long-term obligations better than the other 4 companies and the industry. Marriott is 4 times more efficient than the average hotel. Unfortunately, the profit margin and return on assets are very low. The tax burden and interest burden are quite high. In addition, Their operating margin is very low. Although their asset turnover is very good, all of the other aspects bring the ROA down. I was not able to pull information for the leverage or the return on equity. For 2011, I was able to get the equity multiplier, and it was at a high 18.52. Because they were highly levered in 2011, it would bring their ROE up to almost 50% from 2%. Leverage drove the ROE in 2011. In the other years, it looks as if the asset turnover helped increase the return on assets. Marriott is expected to grow in the future according to their price-earnings ratio. From the negative market to book, we can see that they have a negative asset value recorded on the books, but still expect to generate cash from their assets. Over the last 5 years, the market to book has shown a lower and lower value of what is expected to be generated off of the assets. Marriott has added value to the company over the years, and as of 2015, they were valued at $21.2 billion. Today, their current stock price is $126.86. Choice hotels are a bit more liquid than the industry average, and they have a large portion of cash, which is valuable. Unfortunately, I was unable to gather information on the leverage of Choice hotels, but we can see that the debt they have, they can afford it very well, even better than the industry average. Choice hotels have an industry average 3 times higher than their competitors, meaning they are very efficient. Their average profit margin is around 17%, and the industry average is around 18%, so they are slightly below average in that regard. The return on assets is approximately 5 times higher than the industry. Unfortunately, I was again unable to find information on the return on equity and equity multiplier. However, return on equity cannot be lower than 1, so their ROE would be greater or equal to their return on assets. I assume they will have a higher ROE. Choice Hotels is expected to grow in the future relative to the past. From the negative market to book, we can see that they have a negative value recorded on the books for their assets, but still expect to generate cash from those assets. There was a big jump from what we thought shareholders could generate on their money and assets from 2011 to 2012. After 2012, the expectation slowly increases, but never reaches what it was in 2011. Choice has consistently added value to their company, and it is now worth $3.5 billion as of 2015. Today their stock price is at $77.85 per share. Belmont is quite liquid, like Hyatt and Choice hotels. Oddly though, they have a lot tied up in inventory, which is somewhat odd for a hotel. Come to find out, they own their own train, safari, and boat tour systems, and have restaurants that have played a role in tying up their current assets in inventory. To generate assets, Belmont gets funds, half from creditors and half from shareholders on average. Over their 5 years, they seem to get a little more and a little more from creditors and become more levered. Unlike any of the companies analyzed so far, they've had trouble meeting their interest obligations. In 2000 and in 2013, they were less than 1. Answering the question overall if they can afford their debt, it's a little hard to say because it's so volatile in the short amount of years that we're analyzing. On the flip side, they were able to best cover their interest obligation in 2015 or the most recent year. It's a good thing that they're not very highly levered, or they would not have been able to afford it. Belmont has the lowest efficiency of all 10 companies that were analyzed. They also had the lowest profit margin, ROA, and ROE. It's actually negative. In 2011 and in 2013, a loss before interest and taxes made for a negative interest burden, resulting in negative returns. In 2012 and in 2014, a negative net income resulted in a negative tax burden, creating a negative return on equity. In 2015, things got better for Belmont and they had a positive return on assets and equity. In 2015, a low asset turnover and operating margin drove the ROE down. Belmont has expected growth over the last 5 years, but each year was dramatically different. The lowest expectation was $56.71 for today's dollar, which is very good. Surprisingly, they have not added any value to the company, but are still expected to grow year after year. As of 2015, they were worth $1.4 billion, and their stock today is at $12.40 per share. Redline Hotels had a bad year in 2012, but overall they have been liquid. They have a large portion of their current assets tied up in inventory. They borrow more from shareholders than creditors, which is good in this situation because they have not always been able to afford their debt. In 2011, they could not afford just their interest obligations to creditors. In 2012 and 13, they had negative earnings before even paying taxes to the government and interest to creditors. In 2014, they were finally able to afford their debt, and in 2015, they were close to handling their debt as well as their competitors. Upward trends are always good and give investors a good guess that it will continue. Redline Hotels is equally efficient to the industry. They had a negative profit margin, ROA and ROE. In 2016, the loss was due to a negative net income. In 2012 and in 2013, it was due to a loss before interest and taxes. This is a very volatile company. They do not have trends to analyze or make predictions from. In 2014 and 15, a low operating margin is driving the ROE down. Additionally, this company pays the most in interest of all the companies analyzed so far. Unfortunately, I was unable to find the price-earnings ratio for Redline. However, with just the ratio from 2011, we see that they expected to grow at that time. Redline was expecting to generate less than $1 in sales for every dollar in assets for 3 of the 5 years. One year it was 1-to-1, though last year they finally expected to generate more in sales than the value of their assets. But unfortunately, not very much. From 2011 to 2013, Redline did not add any value to their company, but they added value in 2014 and 15. As of 2015, they were worth $219.7 million, and their stock today is selling for $9.10 per share. The hotels that I chose to analyze were below average in most categories. However, the Marriott was the best of the 5. They were not liquid and had more current liabilities than current assets, but were able to meet their long-term obligations better than the industry and the other 4 companies. Marriott was profitable, but only by a little. However, they grew more profitable over the 5 years. They were the most efficient of all the companies and more efficient than the market. Finally, they were valued by the market. There were some similarities and differences between the 2 industries. So the short-term ratios seem to be similar, but the long-term efficiency, profitability, and market values between the 2 industries were very different. In conclusion, the best company that we analyzed of the 10 companies today was Roche Holdings.